What's happening, everybody? Sorry about that. We're running a little bit late behind on like some scheduling stuff, but we are here. We're finally in and live, and hopefully everything is running okay. I see a couple drop frames. Let's hopefully see this thing through. Hope you're doing well. My name is D. Kumar. Welcome to the exam breakdown today on Wednesday, February 26th, 2025. All right, so a little bit behind. Had a couple things going on today. Had a kiddo I had to take to a doctor's appointment and double check some stuff, make sure she's doing all right. My daughter, she's faints. She gets faint, and she's been doing this for a while, but we just wanted to make sure that there was nothing further beyond just the fainting piece. So we had to check out the cardiologist, and it never fun. And my heart goes out to families that have kids that are going through some stuff, and it's just terrible to be able to go through all that. But I'm just sharing with you a little bit because that's what we were doing. Poor little thing had to get an echocardiogram, an EKG. She's 8, so she hates the little stickers. She hates bandages and stuff, and she gets really upset by taking them off. So she was brave. We went through it. The appointment was long. Man, it was like 4 hours long. But at the end of it, everything was great. She got a checkup. They feel very comfortable that it isn't something bigger than that. And she's been given the doctor's orders to eat plenty of sugar and salt. So good for her. All right. So we're back in here. Today is NMLS day. Today is the day we go through mortgage content. And what I want to do today is I want to basically go through some Q&As that we've been getting over the years. We sift through, we've got this huge catalog of questions that students have asked me over the years, and we started to distill them down and go, okay, what's relevant for examination purposes? What's relevant for this and that? Let's try to condense this stuff down and go through it, and we'll hit a couple questions along the way. The idea here is we're going to go for maybe about 25 to 30 minutes of a power-packed sort of session. We're going to learn a bunch of stuff and stuff that's sort of relevant to it. As always, if you are live with us today, feel free to shoot up some comments and ask us questions. If not, no big deal. They'll post this right after we go live. So it's pretty much instantaneous. You can check it out. Questions and comments and feedback, all appreciated. If there's anything we can do to help, move along the studying, great. If there's anything that you would like to know about real estate, generally speaking, we are happy to answer those questions. I have a ridiculous amount of experience, and so does my team. We've been doing this for a long time, not just brokerage, which I don't practice, but I have been involved, and I've owned a company that's done that. But for me, it's mostly investments and sort of building on investments and sort of understanding the real estate space pretty well. And that's sort of that, plus sort of like a like for teaching. I like being with y'all. Thank you for subscribing to the channel. We really appreciate it. The channel's growing like crazy. For some of our friends that are out there that have been purchasing some of our content, like books and materials, what would be fantastic, if you don't mind, is if you can go back to like Amazon and leave us a review. We're trying to build up our base there, and we're getting amazing comments in our comment sections here on YouTube. But if you have purchased, only if you have purchased, of course, and you're happy with what you have, some feedback would be tremendous. Thank you for all of the feedback and all of the comments. We've gotten a ton this week, lots of questions about things, and we're here to answer them. So we're looking forward to helping you all out. Hopefully this will help you get through this examination. Let's jump in without further ado, and let's jump into some of these questions. I'm just looking over my shoulder. Just want to make sure some of our stuff is streaming, and I want to make sure that it's streaming properly. We look okay. All right. So the first question that we've been talking about for a while, and it's a classic question, is what is the difference between PMI and MIP? And so both of them, PMI and MIP, where they're similar, the question is what is the difference? But they're similar in these letters. And these letters stand for mortgage insurance. And so what is mortgage insurance? It's useful that we break it down because it exists. And for exam purposes, I would tell you that you're probably going to see this on exams. Again, I don't have a copy of your examination. I just have a really good targeting system, and I know what test writers like to write about, and I know the subject very, very, very well. So I can look through the books, every single book on the planet, and I can say that's probably going to be on there. I'd ask you that if I were the test writer, and that's probably something you really don't need to know. So my expertise is in cutting through the nonsense and saying I don't think this is important. And I think PMI is important. I think MIP is important. Mortgage insurance is a type of insurance. And again, all insurance is risk mitigation, right? It's just a third party saying, hey, look, pay me some money. And if this risk that you're worried about happens in your life, I'll pay for it. But you keep paying me. Now, if that risk doesn't happen, you keep paying me. And that's my upside. So I'm looking at the statistics and the odds of how likely is that going to be a possibility. And then I'm going to say, yeah, well, based on that, I'll take that. Now, if I pool insurance with a bunch of other folks like me, well, then all of a sudden now the insurance company has a profit motive to be able to insure larger pools of folks. So if we take this idea of risk aversion, risk mitigation, which is insurance, and we apply it to the mortgage business, the biggest risk is the lender saying, look, consumers want to put down lower and lower down payments. I mean, it's not like that they want to always. I mean, so income disparities, and you have housing prices on the rise, you have inflation, you have all of these macroeconomic issues that are happening, interest rates being high, and all of those contribute to less and less house, in essence, or more and more down payments that you're looking to not be able to come up with. And so high leverage financing, meaning you put less down and the lender loans you more money. But if you look at it from the lender's perspective, the lender is saying this is a lot of risk. Well, you know, if somebody's putting down 3.5% and the lender's loaning 96.5% loan to value, like in an FHA loan, well, what if they default? What if they can't pay? What if the market declines even a little bit? That could put this loan upside down. And there's a lot of moral suasion in when a consumer owes more than the thing is worth, that they may not think that that investment's a good, valuable investment. And so this risk is what the mortgage insurance companies come in and do. They say, hey, listen, in the world of private mortgage insurance, which affects the conventional loan markets, and really, this is something that you should understand. There are two loan markets primarily. I'm going to use this very simplistic understanding here. There's conventional lending, and then there's government sector. Okay? A conventional loan is where the bank is taking risk. And a government sector loan, those are things like FHA, VA, and USDA for your exam purposes. So we've got these two sectors. Inside of the conventional loan markets, we can further break these down into two subcategories. One is conforming, and one is non-conforming. Okay. So we've got these 5 categories or subcategories. We've got these 2 main categories, one being conventional sector and one being government sector. Now, in the conventional markets, that's where the bank is taking on risk. The bank says, look, consumer, if you're going to put down a lower down payment, I need insurance because this insurance is going to guarantee me for anything risky. Now, what is risk in the conventional loan markets? That's when a consumer puts down less than 20%. All right. So we have established as a societal norm in the banking industry that 20% or more down constitutes a relatively safe loan in terms of if I loan you 80% loan to value, so if it's a $100,000 home and I loan you $80,000 and you put down $20,000, well, if I have to foreclose and all these other things, all of the costs associated with the foreclosures, the legal actions and everything else, I still should be able to make my money back. And that's the logic here. So in that, we have this scenario where anything less than 20% is going to say is now risky. And because it's risky, we're going to require it to have mortgage insurance. Now, the conventional loan markets are where the bank takes risk. So these are private loan markets. We can sell to a large purchaser, that being like Fannie Mae, I'm sure you've heard of, or Freddie Mac, or Ginnie Mae for government sector stuff. And so we have this robust secondary market, but that has nothing to do with it. That's conforming versus non-conforming. But the private sector, the conventional loan markets, they call their mortgage insurance PMI, private mortgage insurance. Now, FHA is MIP. So MIP is for the government sector FHAs. And as a matter of fact, the Federal Housing Administration, the FHA, is simply a public sector insurance company. They insure lenders. All insurance, mortgage insurance, insures lenders against risk from default of borrowers that put down riskier down payments, being high loan to value, low down payments. And when you have that scenario, these mortgage insurance products are a requirement. So private mortgage insurance applies to conventional loans when the down payments are less than 20%. It can be removed once the borrower reaches 20% equity. As a matter of fact, when we get to 22% equity, there's a law that's called the HPA, the Homeowners Protection Act, and that requires that PMI auto cancel. That's something that I would know for your exams. Mortgage insurance premium, or MIP, is required for FHA loans, as we just mentioned, regardless of the down payment, and includes both an upfront mortgage insurance premium, they call this UF-MIP, and an annual premium. MIP remains for the life of the loan unless we refinance and get out of it and move to the conventional loan market. So that's another thing that you want to know. You want to know that MIP lasts for the life of the loan, and PMI auto cancels at 22% equity. And at 20% equity, we can petition the bank to go ahead and say, hey, can we remove the PMI? I'm just going to jump here. All right. Boom. So there's a basic understanding of what PMI and MIP is. A couple of things about like the Homeowners Protection Act, of the law that cancels it. 22% equities auto cancellation. Private mortgage insurance affects the conventional loan markets. And then the government sector FHA programs, those are insurance called MIP, mortgage insurance premium. You definitely want to know how this stuff works. On the FHA loans, you might want to study a factors chart to determine what type of coverage you need at certain loan to values or down payments. And I've seen those in publications all over the United States. So you, depending on where you're taking your 20-hour course or your NMLS approved course, that's something you might want to know. I know for a fact when we do our program, we do that. We talk about that. We talk about factors as well. And that typically serves you all well. All right. So that's that question there. Again, I could go into it for the entire segment even longer if we're going to look into it, but these are some of the basics. The next question is, what is the minimum credit score required for an FHA loan? Now, you definitely are going to need to know some qualification standards for the FHA, things like some minimum FICO score requirements or credit score requirements, things like down payments, and things like debt to income ratios, right? So you want to know those, like 3143 for FHA to qualify an applicant, and you want to know 2836 for conforming conventional loans. So you want to know some of this stuff also. So you're definitely going to know that, what that is. But the minimum credit score requirements for an FHA loan are something that you might want to know here. Oh, that just jumped. Sometimes my technology acts weird when I download stuff onto it. Here we go. The minimum credit score requirements for an FHA loan, the FICO score for an FHA loan is 500 is the minimum FICO score. That comes with a 10% down. You have to put down at least 10% if you have a 500 FICO. If you're at 580, you can put down 3.5% as a down payment. Now, lenders may have stricter requirements at the lender, but generally speaking, the FHA would still insure an applicant with a credit profile that have these items. So you want to know that you can go financing as low as 500 FICOs. Let's try this question. A borrower is applying for an FHA loan with the 3.5% down payment. What type of mortgage insurance will they be required to pay? Letter A, private mortgage insurance, PMI, until they reach 20% equity. Letter B, private mortgage insurance, PMI, until they reach 22% equity. Letter C, mortgage insurance premium, which may last for the entire life of the loan. Letter D, no mortgage insurance is required if they have a high enough credit score? And the answer? Letter C, mortgage insurance premium or MIP, which may last the entire life of the loan. So MIP has this feature that could last for a very long time. There are changes that are constantly being made to the FHA and what they require in terms of insurance and what they don't. So you want to double check before you sit for the examination what those are. Just make sure. Many publications, again, have those. But I would just at least know that MIP is a standard thing, and that goes with FHA loans. So we can eliminate letter B because that's saying PMI. We can eliminate letter A because that's saying PMI, because they're asking for an FHA loan, right? So we know that it's either going to be C or D. And well, D is no mortgage insurance. And if you're dealing with an FHA loan, there's always mortgage insurance. And therefore, C is the answer. Another popular question that I've been asked before is, well, what is the difference, D, between a good faith estimate and a loan estimate? And as many of you know, the TRID rule is something that they're going to be testing you on. We've done videos in the past. We'll continue to do videos in the future about the TRID rule. It's going to be on there. The TRID rule requires two documents that are relevant to y'all: the loan estimate and the closing disclosure. Now, prior to these changes, which were implemented in around 2015, I don't think they're going to test you on the year, but that's when they were rolled out. Prior to those changes, we had something called the good faith estimate, which is basically the same idea, was the same spirit of what the LE is. It's to give the consumer transparent understanding of what the costs to be able to do a transaction are. So that's what the loan estimate and the good faith estimate are in similarity. But the difference is the following. A good faith estimate is used before 2015 under the RESPA rule to outline estimated closing costs, and a loan estimate, the LE, replaces the good faith estimate under the TRID rule. Now, it provides a clearer, standardized loan cost disclosure within 3 business days of application. That is absolutely something you want to know for your exam. For your examination. And the other thing that you want to know is, if it's not a covered transaction, then a lender can still use a good faith estimate if it's a transaction that's not covered under RESPA. And for y'all that don't know, or you just learned, in RESPA is the Real Estate Settlement Procedures Act, implemented by Reg X. So it's not covered. So you want to look up what are covered transactions under RESPA. And if it's a covered transaction, then it will require a loan estimate. If it is not a covered transaction, then a lender can still show their costs and estimated costs on a document called the good faith estimate. Regulators are only looking for compliance with covered transactions. And that's really why the LE is what it is today. All right, so you want to know that about the LE. The next one is something that we were kind of chatting about before. What is the difference between a conforming loan and a non-conforming loan? What is the difference between a conforming loan and a non-conforming loan? And what we got here, I'll read this to you, and then I'll elaborate if I need to. A conforming loan meets Fannie and Freddie guidelines. So Fannie Mae is also known as FNMA, and Freddie Mac is FHLMC. You want to know what these stand for. So Fannie Mae stands for the Federal National Mortgage Association, and Freddie Mac stands for the Federal Home Loan Mortgage Corporation. Both of these two are secondary market players. So here's the idea. Let me just kind of give it to you in a sort of a high-level understanding. So in the conventional loan market, we had 2 subcategories. if you look back a little bit. One was the conforming sector and one was the non-conforming sector. The conforming loan market is a market that you can sell a loan to Fannie Mae or Freddie Mac and they'll buy it. Now, why would they buy a loan? They're in the business of buying loans. What they do is they decide what they want to buy and they raise money to buy that particular investment. So how do they figure it out? They come up with guidelines. So Fannie and Freddie are guideline creating investors, basically. And they say, hey, look, just like any investor, here's my investment criterion. This is what I'm looking for. This is what I'll buy. I mean, if you're an investor, you're not buying everything. Some people want to invest in things like crypto. Some people don't want to invest in crypto. Some people only invest in blue chip stocks. Some people only buy real estate. Some people only. So what, as an investor, and now all of these types of investors have made tons of money by investing, right? Like, so it's not like you can sit there and say, well, this one versus that one versus this one. Money is money. And if you're making a ton of it, at one point in sort of diminishing returns, you're going to say, I have more than I need, right? So like, I'm not trying to say, well, Warren Buffett has made more than this guy. And this, so I'm not saying that. I'm not saying who ultimately has the most money. But like, if you look at somebody like an Elon Musk, Musk is somebody that's vested in businesses that he happens to run. So, if you're looking at the business buying play, that's another investment strategy. That's a strategy that I'm into, buying businesses. And so like, it's not just about real estate. It's also understanding where you want to put your investment dollars. Now, that being said, Fannie and Freddie are investors and they come up with what they're looking to buy. Now, some investors are very super conservative. Hey, I only want to buy a company or I only want to do something if this is the numbers that I'm seeing. And if these are the numbers that I'm seeing, I'm willing to pay a premium price for, a fair price for a business that's generating this for me. And just like that, Fannie and Freddie come up with their risk appetite, their risk guidelines. And then they say, hey, banks all over the place, if you write a loan that fits what we think we want to buy, as long as we can make sure that this is what it is, this appraisal comes in, this value, this income, this asset, this credit, this employment, all of these guidelines, then you can sell us that loan. We'll give you your money back. So a lender makes a loan to a consumer. They follow Fannie or Freddie's guidelines, and then what they do is they just transfer it to Fannie or Freddie. And so and then Fannie and Freddie cuts it up and puts it into a bunch of different pieces, and they sell those off to investors on a global market. So basically, the world can buy into the U.S. housing market. They get their money back. It's recapitalized, and then we give the bank their money. The bank gets their money. They have like application fees and origination fees, and then they move on to the next transaction. They get their $100,000 back, and then they keep lending that back out. Non-conforming loans simply means it does not meet the Fannie or Freddie guidelines. Jumbo loans, because Fannie and Freddie say we'll only loan up, buy loans up to a certain loan amount. So the conforming limits are what those numbers are. Portfolio loans, loans that you're going to keep on your books, and government-backed loans like FHA and VA, all of which make up the non-conforming sector. But I even further dissected it and I said, look, put the government loans in its own tier. So we have government sector and conventional markets. That's private risk versus public sector risk, right? Because that's really what it is. And then you have conforming and non-conforming, and then you have government sector. So just keep it that way. Go back and check out this replay a little bit, and you'll see what I'm talking about in the earlier question. The next question is, how does the qualified mortgage rule, the QM rule, impact loan underwriting? A good question. The QM rule is something that you're going to see on these examinations. It's on the outlines. I would suspect that it's definitely something you need to understand. Qualified mortgages established under the Dodd-Frank Act require lenders to verify a borrower's, this is the most important piece, ability to repay the ATR. In order to do that, a qualified mortgage must have no toxic loan features, so nothing like negative amortization, interest only, or loan terms over 40 years. Keep a debt-to-income ratio at least 43% or below, except for temporary backed loans. There are exceptions here. This is generally speaking, and include fully documented income and assets, and must not have excessive points and fees, typically capped at 3% of the loan amount. So these elements are all the things that make up a qualified mortgage. Basically, if you look at it simplistically, a qualified mortgage is a safe loan. Qualified mortgage rule is a loan that has been vetted to the consumer, in which the consumer has been vetted to be able to have the ability and willingness to pay it back, the capacity to be able to pay it back, the ability to repay. And if a lender makes a qualified mortgage, it's putting the lender in a safe position. So a lot of bailouts happened during the 2008 to 2010 economic crisis because lenders made irresponsible mistakes. And what ended up happening, and by proxy, consumers made choices that weren't the best. So all of this stuff happened in these subprime markets and these tougher, riskier loan products. So the qualified mortgage rule basically was written to say, hey, look, lender, make a safe loan. If you make a safe loan and verify a consumer's ability to repay, make them a loan that has safe features, things like 30-year fixed, fully amortizing loans. As a matter of fact, that's a traditional loan by definition. If you're studying this stuff right now, you'll see something called a traditional loan. That's a traditional loan, 30-year fixed, fully amortizing. And if a loan deviates from that, a 15-year fix is fine also. But if a 30-year fixed mortgage is really that's the best thing for them, then that's the thing that they should be being offered. And if they're being offered that, also make sure that they have the ability to repay this loan, like verify their income, verify their employment, verify their credit, verify all this stuff. If they are good, if they're good to go, well, then make the loan. And if you do that, you are in a safe place, lender. If something bad happens and this borrower defaults, and if you decide to foreclose on them, if you didn't write them a safe loan, if you didn't follow the qualified mortgage rule, if you didn't follow all these rules that we kind of gave you, well, then you lose your ability potentially to foreclose on them. You may not be able to because you gave them a loan that was a higher probability that they were going to default. So you write a bad loan for a consumer, well, then you might lose your safe harbor. The safe harbor rule is basically saying, if you do what you're supposed to do, bank, and if a bank were like a ship in the ocean, in the open water, and a storm is coming in, well, you want to get out of the open water and you want to get to shore. You want to dock your boat. You want to get into a harbor and hunker down, right? And just like that metaphor, if you look at it in terms of a lender and the lender is the ship, well, if they don't write a safe loan to a consumer and they have to foreclose because of default, the courts could say you don't have the foreclosure privilege anymore. Your safe harbor has been taken away. This is on you. You're on your own here. We will not let you entry into the harbor. And so that's the idea of the safe harbor rule, the qualified mortgage rule, and the ability to repay. It just basically says we have to write loans that are safe for consumers. A lender wants to issue a qualified mortgage under the ability to repay rule. Which of the following features would make the loan a non-QM loan? Letter A, a 30-year fixed rate loan with fully documented income. Letter B, a debt-to-income ratio of 42%. Letter C, a loan with 2.5% total points and fees. Letter D, a 3-1 adjustable rate mortgage with a 40-year term. A lender wants to issue a qualified mortgage under the ability to repay rule, the ATR rule. Which of the following features would make the loan non-QM? And the answer is letter D, a 3-1 adjustable rate mortgage. By the way, 3-1, for those that don't know, you should. We'll talk about these at some point. A 3-1 is a hybrid ARM. A hybrid ARM means it's fixed for 3 years, and then it adjusts annually for one time, and then it sets itself for the next 12 payments. So a 3-1 ARM is a hybrid. It's fixed for that 3-year period, and then it's adjustable for another. It doesn't adjust every month. It sets itself for 1 year, and then it adjusts, and then it's good for 12 more payments. then it adjusts again, and then before it gets to that 12th payment, and then it sets it for the next term. So that's what a 3-1 ARM is, by the way. You would definitely want to learn about the hybrids for sure. But all of these other answers are what makes up a qualified mortgage. So go back to that slide and check out what makes up a qualified mortgage. You're going to need to internalize that stuff for your exam. Another question that we have had in the past is, what's the difference between the lien theory and the title theory states? So there are two theories of lending, and we want to know the difference between these two as well. So in a lien theory state, the borrower holds legal title to the property while the lender only has a lien or a security interest known as a mortgage. The lender must go through the judicial foreclosure process, which means asking the court for permission to reclaim the property if the borrower defaults. However, in a title theory state, the lender or trustee holds on to legal title to the property. So think like a car loan. If you have a car that has a loan, you don't have the title to your vehicle. The title is being held by the finance company, or a representative that the finance company trusts, a trustee. The trustee is the receiver of trust. The trustor is the giver of trust. So the lender says, look, you owe us money on this car. I don't want you to have the title because you could just sell the car and we never get paid back. So for safekeeping, we're going to hold on to the title. You have the keys to the car. You have the right to drive that car around so long as you pay up your debt. And if you decide to sell it, you have to call us up and say, hey, I'm going to sell the car. And then the finance company gets involved to make sure that if they do turn over the title, that they get their money for the loan. And so that's how this whole thing works. But we did it to a home loan, basically. And in title theory states, if the loan is repaid, if the borrower defaults in a title theory state, then the lender can use a non-judicial foreclosure process, which is typically faster. So this is what you see. Now, every state has something different. However, you're not going to be tested state to state for this particular examination. So there are state-specific exams. So you really don't need to know this for this examination outside of the basic definitions. So in a lien theory state, the borrower owns the property, has the deed, and there is a lien placed on the property in the form of a mortgage. In a title theory state, we have a trust that's created, and in this trust, the trustee holds on to legal title or the deed. Legal title is just a fancy way of saying the deed, by the way. And that's sort of how lien theory versus title theory goes. Which of the following is true in a lien theory state? Letter A, the lender retains legal title until the loan is paid off. Letter B, the borrower holds legal title and the lender has a security interest. Letter C, the lender can foreclose without going through the courts or a non-judicial foreclosure. Letter D, a trustee holds title to the property on behalf of the lender. Which of the following is true in a lien theory state? And the answer is letter B. The borrower holds legal title and the lender has a security interest. So in lien theory, the borrower has the deed and a lender has a mortgage. The security interest is called a mortgage. Remember, all a mortgage is just a lien. By the way, you do want to know who is the mortgagor and who's the mortgagee. Remember, the mortgagor is the borrower and the mortgagee is the lender. That's a trick that you're going to see, I would bet, on an exam like this. And the final one here is, can a borrower pay for discount points after the mortgage has already been created, or do they have to refinance? Now, what is a discount point? A discount point is a way that a lender can increase their yield And the borrower benefits by lowering their market interest rate below market interest rate. So I'm just giving you a very hypothetical. Let's say if the current mortgage market is at 7.5%, and let's say if I paid 2 discount points, whatever that is, a discount point is one discount point is a percentage, 1% of the loan amount. All points are 1% of the loan amount. So if you pay a discount point, it's 1%. 2 discount points would be 2% of the loan amount. So it would be, let's say, on a $100,000 loan, it would be $2,000. So the question here is asking, can a borrower pay for discount points to lower the interest rate below market? I'm just using a very crude example here. Let's say I said the rates were 7.5%. Let's say if you paid 2 discount points, 2%. I'm making this number up, by the way. Let's say if you you pay 2 points, it drops your rate. I'm just making this up to 5.5%. So let's say that's a significant spread. That's not going to be the drop. But I'm just giving you this for visual understanding. So let's say if you could buy down the rate, so now the borrower has what? A 5.5% interest rate for a period of time, or it could be a permanent buy down, or it could be a temporary buy down, right? There's 2 different ways you can do it. A permanent buy down would be buying that rate down to 5.5 for the life of the loan. Well, why would that happen? So let's say we have a housing market where there is a huge amount of supply and the demand drops. So in that particular case, you have a high level of inventory of homes that aren't moving. And if that's the case, maybe the seller, the developer wants to incentivize the purchase and say, hey, look, if you buy my house, if you buy any other house that's comparable to my home, well, you're going to pay 7.5%. But if you buy my house, your rate's going to be at 5.5% because I will buy it down for you. So this could be a seller paid buy down. Okay, so that's the idea. Let's say you have a bunch of cash. Let's say if you have an employer that really wants you to move or relocate to an area, they might pay your closing costs. They might buy your rate down potentially. I mean, if you're, awesome, super cool, and very valuable in the marketplace, man, they'll do anything to bring you in. Hey, look, we'll buy you the dang house. We'll finance it for you. We'll pay all your closing costs. We'll buy down your rate to a super low rate, as low as they'll sell it to us. So there's just an idea of why buy downs. Now, the question is after the mortgage has already been created, or do you have to refinance? Can a borrower pay for a discount point after the loan is closed? And the answer here is no. Discount points must be purchased at the loan origination, so when you close the deal. If a borrower wants to lower their rate later using discount points, they must refinance and pay the points at closing. Lenders may offer options for loan modifications or recasting a loan. So if you are in a super low rate, a question to ask is, can I recast my mortgage? Let's say you've paid down your principal significantly and you'd like to have the same terms, the low rate, but just have them readjust the payment structure because now you owe way less. And so you can always ask your bank, petition your lender and say, hey, do you offer recasting or do you offer a loan modification for good borrowers that want to just, rechange their monthly payments because they've paid down a significant chunk of principal, whatever. You have a windfall in investment. You want to pay down your mortgage, pay it off potentially. Sometimes there's negative effects, right? But sometimes there's positive effects of paying down the debt. And so based off of all of these decisions that you're going to make, this is just one more. If you're going to get discount points, you have to pay for them at the closing. All right. All right, my friends, that was exam breakdown for today, February 26, 2025. We went through a couple of popular questions that we've been asked about potentials on the NMLS examination. These are things that I would focus on. The discount point, I would just know how to calculate a discount point and what the basic definition is. Again, we talked about what a permanent buy down is. We talked about what a temporary buy down is. You want to look those definitions up. We talked about qualified mortgage rule, the ability to repay rule. We talked about the good faith estimate versus the loan estimate, the TRID rule, all things you're going to definitely want to know. You definitely want to know what the 2 loan markets are, conventional loans and government sector. You want to know the difference between PMI and MIP. So review this. This stuff is good stuff for examinations. I would suspect that you are going to see and feel things like this. I wish you much success in the time that you've spent studying for this exam and ultimately passing it. If there's anything we can do to help you further, please leave it in the comments. And we do listen, we do read, and we do get back to our subscribers. We really appreciate the time that you're spending with us. Our channel is blowing up, so thank you from the bottom of my heart, from my family's heart, from my crew's heart. All of us are so excited to be here doing what we're doing to help you get through this examination. Check us out. Subscribe to the channel if you haven't. Good luck with your studies and good luck on your tests. We will see you every Monday and Wednesday live for exam breakdowns, unless, the kids are home from school break or something like that. We'll let you know in the community posts if we're not posting. We started late today because I had a prior obligation, so my apologies. But again, we're here, we're done, we're studied. Good luck, and we'll see you very soon. Hey, we've got some really cool stuff that we're about to drop, some medium form and long form video content that's going to be sick and killer. We're also working on a top secret G14 classified thing that I know we're going to do it. Now, this thing is going to be for sale ultimately, but it is awesome and so amazingly worth it. If you can, put in the phrase like kind of done for you, ease, risk free, and fast. If we can add all of those value metrics to it, this is what we're building for you. All right, so more about that coming up. Check out other videos. We just put out the 2025 questions for the real estate folks. Real estate folks we do on Mondays. Mortgage originators we do on Wednesdays. Good luck. We will see y'all soon.